Good afternoon to our viewers in Switzerland and good morning to everyone joining us in America. It is, as always, a great pleasure to welcome you in the name of the Latin American Chamber in Switzerland, Chamber of Commerce in Switzerland, for the fifth consecutive time to our traditional UBS Patrons webinar, which will assess the overall economic and financial situation and provide an outlook for Latin America. This year's UBS motto is Escape Velocity, a question. We have reached the second half of this decade. Most of you, I assume, will agree with me that the world today in many ways doesn't resemble anymore the world of a year ago. Our ability to cope at the same time with multiple, previously almost unimaginable events and with their impact on lives and on society has been put to a whole new level of test. But one choice prevails. Any disruption can be felt either like a nightmare or like a push to seize new opportunities. At LATCAM, we like to always focus on finding the positive edge. So does our guest speaker. Most of you are familiar with his in-depth and succinct analysis. As the Chief Investment Officer, Emerging Markets Americas at UBS Global Wealth Management, his opinion is widely respected. A warm welcome once again, Alejo Czerwonko. Before we listen to your presentation, it is my great pleasure to introduce our board member, Luis Cardoso, Managing Director and Head of the UBS Wealth Management International Latin America Department, who will provide introductory remarks in a moment. A warm welcome to you too, Luis. Dear viewers, this webinar is, as always, recorded for our YouTube channel, LATCAM Switzerland. There will be time for Q&A after Alejo's presentation. If you have a question, please write it in the Q&A section of your toolbar. You can also do this anonymously. And now I'm inviting Luis Cardoso to address this audience, immediately followed by Alejo Czerwonko. Please, Luis, the virtual floor is yours.
Thank you, Tatiana, and good morning, good afternoon to all of you. It's an absolute pleasure to join you on this webinar. I think, Tatiana, against that backdrop, you described probably a lot what I and Alejo are going to say in many more words. But let me obviously extend a thank you as well to the Latin America Chamber of Commerce for the opportunity to share our perspectives. And I'll be brief on my introductory remarks, which will focus on three topics. I'll give a quick highlight of UBS results, a brief overview of UBS LATAM operations in wealth management, and also a very brief overview of how we see markets. Now, in the last quarter, so in the fourth quarter of 2025, UBS reported net profits of 1.2 billion with underlying pre-tax profit growth across all our businesses. The group invested assets exceeded 7 trillion of assets, a record for UBS. GWM, so our global wealth management division, delivered a pre-tax profit of 1.6 billion for the quarter, and that's up 1.1 billion from the previous year on the back of strong revenue growth. All our four GWM regions grew pre-tax profits in 2025, and that includes our own Latin America wealth management region. And each one generated around 1.5 billion of PBT, so profit before tax, excluding litigation. This just shows the strength of the franchise. We'll continue to be the world's only truly global wealth manager, and this diversification across regions is our strongest testament. In regards to integration, we remain on track to deliver on our key integration milestones, including completing the Swiss booking center client migrations by the end of this quarter. And as a recap, we are the first and only global systemic investment bank, important bank, I should say, to integrate another global systemic important bank. Now, moving ahead to our beloved LATAM region. UBS history in the region is rich. We are proud to be in the region for over 65 years. A footprint that spans from the north to the south. We have offices across Brazil, Chile, Mexico, Colombia, Panama, and Uruguay. And to serve all of these, we have dedicated booking centers for Latin American clients in Switzerland, United States, Germany, and Brazil. Clients are at the center of everything we do. And this combination of global scale with deep local presence gives us real insight into the cycles, needs, and sophistication of families in the region. And what better region to focus than LATAM? Alejo will shortly build the argument of why emerging markets and LATAM more specifically are back in the map, but allow me to highlight a few points. LATAM sits at the center of global themes: energy transition. Brazil, Chile, Argentina are leading in clean energy, biofuels, hydrogen, lithium. Food security, one of the most important global suppliers of food. Critical minerals and biodiversity. Nearshoring momentum. We all read the news every day about Mexico and the importance of the country. And more importantly, the region experienced significant wealth creation. This matters because LATAM families are no longer spectators. They are becoming global allocators, increasingly sophisticated and focused on long-term governance and diversification. But the challenges remain real. We have higher for longer, remains part of the global conversation, and rate divergency between the Fed, the European Central Bank, and Latin American central banks adds complexity. Inflation is lower, but still sticky in major economies. Geopolitical fragmentation is reshaping trade flows and supply chains. Regionally, fiscal pressures and political volatility affect expectations in Brazil, Mexico, Argentina, and others. So clients today, they need resilience, multi-jurisdictional planning, offshore allocation, and disciplined investing. In one word, clients need advice. We're not in a regular cycle. The global economy is undergoing a structural reconfiguration. We are in a moment of deep global transition. It's exactly in these environments that clarity and context becomes essential. So with that, I'll hand it over to Alejo to dive deeper into the macro backdrop and the structural forces shaping the region. Alejo Czerwonko is our CIO for emerging markets with deep LATAM experience. Alejo is also professor at Columbia, where he teaches a course on international capital markets. But above all, he is a friend of the Latin America Chamber of Commerce. As Tatiana mentioned, he has been leading the Year Ahead Outlook webinar for 5 consecutive years. I think later on I'll invite you to also ask him how often he has been wrong or right in his assessment. He's in high demand across our advisors, clients, and prospects. So I'm very happy that Alejo was able to carve out some time to be here with us today. Alejo, my friend, the floor is yours.
Thank you, Luis, so much for the friendly fire, for reminding participants that they have 5 years of track record of notes to test our ability to project the future. And Tatiana, I greatly appreciate the friendship. It is incredible how well Tatiana, just manages the agenda. She's booked this initiative probably 6 months ago, diligently, and I'm always happy to exchange thoughts with the members, both online and in person. It is a great pleasure to be here again, and I think it's a special year for Latin America. Luis described it very, very nicely. I think we're back on the map as a region. Let me maybe start by highlighting that for the prior 10 to 15 years, Latin America had lost relevance. in terms of economic weight, in terms of importance in financial markets. I do believe 2025 has likely marked an inflection point. And from now on, our region will gain relative relevance. We are living in a world in which there's a soft dollar. There are increasing commodity prices, easy financial conditions, all of which is positive for Latin America growth and development. But in addition, in a fast-changing world in which we see fractures, in the words of Prime Minister Mark Carney in Davos, in which we see a complete reconfiguration of the global geopolitical map and a refocus of countries on issues such as food security, as Luis highlighted, energy security, and technological security, Latin America has answers to all these questions. We can help countries achieve that energy sufficiency, self-sufficiency, something similar with food, of course, and definitely we're sitting on critical mineral stocks, rare earths, lithium, copper, all of which is desperately being sought by major geopolitical powers. If you add to that the fact that leadership from a political perspective in Latin America is changing fast, we are seeing the pink tide of left-wing politicians receding and something new emerging, more towards the right side of the political spectrum. This has been happening for some time already in places like El Salvador, Ecuador, Argentina, but it's been accelerating as of late, evidenced by the case of Bolivia, the case of Chile, and we are looking ahead to a 2026 that will be absolutely crucial from this perspective, with elections in Peru, in Colombia, and arguably the most important one from a symbolic perspective, which is the election in Brazil. And not only is politics domestically changing, but also something that is correlated with this, namely the US is, for the first time in more than 25 years, paying attention to Latin America. We are seeing a rebirth of the so-called Monroe Doctrine. This has been explicitly acknowledged by the current US administration in its latest national security document, published late 2025. This simply means we're going to dedicate, they say, more time, more attention, more resources to Latin America. They've been doing that already since Trump came to office a year ago. If you look at how much the US has gotten involved in Mexican affairs, in Panamanian affairs, in Colombian developments, in Brazilian economics and politics, and of course, the participation of the US in Argentine affairs has been truly historic in nature. So I wanted to start by putting it out there that this year feels different from the prior four that I had the opportunity to address this audience. We're back on the map. We're back on the driver's seat. I think there's going to be more attention, energy, and resources looking at our region in the next 12 plus months. With that introduction, because I really wanted to take that energy that Luis and Tatiana had created to emphasize this new trend, which is so relevant, I think, hopefully to all participants today. I want to show you a few slides explaining what's going on outside of Latin America, the developments that we're seeing at a regional level, and wrap up with a few country-specific comments, if that's okay.
Alejo, can you still hear us? Are you still with us? Seems that we've lost our speaker in the middle of his screen sharing. I hope he will reconnect in a very few moments.
Hello. Yes,
Hello.
I know.
We lost you there for a moment. Glad you're back.
The first time that ever happens, my Zoom restarted automatically. But I think it was a pretty clean cut. Let me go back to the slide deck. I'm assuming you heard about, the year ahead report, and simply I was highlighting its title, which is Escape Velocity with a question mark. And here we simply recognize that there are good things going on in the world. There are more challenging things going on in the world. We think that 2026 will be a year of glass half full from a financial markets perspective, and that risk assets are likely to end the year higher than they started the year. What are some of the positive developments that we see out there? We are living through a technological revolution. AI is an incredibly powerful driver of change that is impacting every single industry. I think simply focusing on the hyperscalers or the chip companies misses the whole picture. You gotta remember that the first fully AI developed drug is advancing through FDA approval in the United States. You gotta acknowledge that, I had a conversation with the CEO of Hyatt globally, and he goes, my sales force is doing in 4 days what they used to do in 5 days, and they're doing it better. Of course, they're not getting the 5th day off, so there's time to go the extra mile, develop new business, and this is something that is leading CEOs, decision makers everywhere to double, triple down investments in implementing, adopting AI developments, AI tools. That's one good thing. The other supportive element of global financial markets is liquidity. There's a pretty favorable global liquidity backdrop as we speak, meaning money is relatively easy. The US Central Bank has been cutting interest rates. They are telling us that they expect to cut interest rates further. The nomination of Kevin Warsh to lead the Fed and succeed Jay Powell has reassured investors that, the worst of central bank independent concerns might be behind us. And therefore, we see a situation in which interest rates, global liquidity should accompany economies and risk assets in 2026. Of course, not everything is rosy. The first month of 2026, January, felt like we are living in dog years. So much has happened from a geopolitical perspective. Venezuela, Greenland, Russia, Ukraine, Iran. It is truly insane if you think about how much water has gone under the bridge in the first few days of 2026. And, Mark Carney in Davos crystallized in very articulate manner the way most of us feel in terms of there being a rupture. We are in a new geopolitical environment. The time of unconstrained globalization, integration, flow of capital, goods, and people across border is over. We are in a new environment characterized by more fragmentation, characterized by more challenging flows of capital, goods, and people across borders, characterized by more tension and conflict. And there's no going back. I think that is the new environment that we're living in. Finally, I will say there is a lot of policy uncertainty, very significant shifts in policy taking place overnight. And I would argue it is no longer clear what's a developed market and what's an emerging market. And I illustrate this maybe somewhat provocatively by asking people to ask ChatGPT who it thinks is more fiscally responsible, right? Who manages fiscal accounts more diligently. Is it a country like Peru or Chile or Poland or Malaysia? Hold on one second. My Siri came up. All right, there we go. Chile, Peru, Poland, or Malaysia on the one hand, or is it the United States, France, and Japan? And ChatGPT will likely come back and tell you quite confidently, it's actually Chile, Peru, Poland, and Malaysia that are doing a much better job at managing fiscal accounts than the US, France, and Japan. So it's a very strange world. Who would have thought that we could make that sort of statement in the past? All right, with that said, that is the background. Let me give you some idea of how we're translating this into actionable insights. Starting with global stock markets, we think that indices such as, the MSCI All Country World Index or the S&P 500 are likely to end 2026 higher than they started. And this will be supported by earnings growth that will be, we think, in the vicinity of 10% for US stocks, 7 to 10% for European stocks, 15% for emerging market stocks, in a global economic environment that is supported by liquidity and AI. As you can see, estimates of where AI CapEx spending is likely to evolve in coming years. This is a microeconomic development that is, individual companies making investment decisions around artificial intelligence, but something that is already having macroeconomic impact. Because when you think about this billions of dollars being invested, yesterday we heard from Google how they plan to double their AI CapEx plan for 2026 vis-a-vis 2024. Just one company is committing to deploy $180 billion in CapEx this year. It's just mind-blowing numbers. This is data centers that are filled in with servers and chips, but that also need the support of engineers and cleaning staff and security staff and insurance policies. So this is actually moving chunks of the economy. Part of the reason why we think global equity markets should continue to trend higher. But let's highlight one theme. We think 2026 is going to be the year of, the great broadening. It's not just going to be about, as I said before, hyperscalers and companies in the US. We think the market should see more broader performance when you think about sectors like financials or healthcare or utilities, or geographically. We think it's key when building an investment portfolio to have a strong foot outside of the US, in Europe, in Asia, in Latin America. Let's talk about fixed income. There is an interesting constellation of factors. Yield levels in fixed income are interesting. You can build a bond portfolio that has an expected return of 5-6% in US dollars without making too much effort. This is historically quite interesting. Now, spread levels, that is the risk premia that some corporate bonds or some lower quality sovereign bonds offer over, say, US Treasuries, is quite tight. So this to us means in the bond space, we wouldn't recommend going overly aggressive in credit exposure or duration, maturity exposure, given how much fiscal mess there is going on in the world. The other thing to consider, given this fractured, tense, conflicting world with active challenges in places like Venezuela or Iran or Russia, Ukraine, or the Middle East at large, Taiwan, this renewed focus on food security, energy security, technological security, we think commodities have further room to run. We favor precious metals. In our view, an asset like gold is being supported by secular improvements in demand. Taking it to the extreme, what did you need gold for in a peaceful, integrated, globalizing world? Now it becomes a very different asset in a tense, fragmented, conflicted world. And we think gold prices, not in the very, very immediate term, but 12 months out, have further room to run. But this conclusion applies more broadly to other commodities, industrial metals such as copper, aluminum. And so we think having commodities in a portfolio is a good idea. Of course, many things can go wrong. Air pockets are typically inevitable. And we're looking at a few areas of concern. What if artificial intelligence and this pharaonic investments fail to monetize as fast as one would think, right? What if it takes longer to recoup these investments, or some investments, don't turn out to be as profitable as one thought? So this is maybe a version of this is actively taking place as we speak in global markets. Our view is that, this monetization will accelerate. There's going to be an increased evidence of the efficiency gains that many companies will enjoy as a result of adopting AI coming in line. And that's why we remain relatively positive, but it's something to consider. Debt dynamics are another source of concern. As I briefly pointed out, countries like the US, France, the UK, Japan have very challenging debt dynamics and are doing little to nothing to address this. And so we will have to live with this Damocles sword hanging over us in terms of, might investors lose confidence in certain assets at some point in time? And what might the trigger of that be? Impossible to pinpoint with a date and a time, but something that you should be mindful of. What if inflation picks up again, forcing central banks such as the US Central Bank to not only not cut interest rates or instead hike interest rates? So that is the world we are living in today. Let's zero in on Latin America. I opened up highlighting that our dear region is back on the map, back in focus. And look, investors are looking at the performance of Latin American assets in 2025. Outstanding. Above and beyond those that can be found almost in any other major market globally. Take a look at equities. They finished the year 55% up in US dollar terms. Latin American currencies delivering 25% total returns versus the dollar. This is including not only spot moves, but interest rate differentials. Our dollar bonds in Latin America on the country side or sovereign side, delivering 17.5% returns in US dollars, outperforming other regions. So these are very sizable numbers that global investors look at and start wondering, should I double click? Should I study Latin America more closely? And they pair that with some of the trends that I highlighted earlier. It is a region that offers solutions to global problems such as food, energy, and technological security concerns. It is a region that is shifting in terms of leadership towards something different, something that creates positive expectations, that in many countries, new leaders are allowing the private sector to operate more freely without so many constraints and without the stigma that the private sector has carried in many Latin American countries under left-wing administrations. And the US focusing on Latin America is another driver, because the US Foreign Minister Marco Rubio has knowledge about the region, has interest in the region, and has been very active traveling and securing US involvement. And I would say, it often takes putting money where your mouth is. And Scott Bessent, US Treasury Secretary, has done just that with Argentina in the second half of 2025. The country not only obtained a $20 billion lifeline from the US Treasury, but the US crossed certain lines that were unimaginable just a couple years ago. For example, Scott Bessent bought Argentine pesos directly in the open market, something that hadn't happened ever before in the history of emerging markets. So that's some indication that the US is willing to at least consider putting money where their mouth is. And this, of course, one could argue, had some impact on Milei's re-election. With Milei's success in the October midterm elections in Argentina of 2025. With that, let's go into some country by country highlights. Brazil. I think there's going to be two main drivers for Brazil in 2026. One is the central bank today has policy rates of 15%. Asphyxiating. Very hard to do business with this prevailing interest rate environment. The good news is the next move is a cut of interest rates with high probability. It's coming, and we will see an easing cycle in monetary policy, we think, throughout 2026 that will support business and financial conditions. In addition, the other signpost is the election, incredibly relevant, incredibly polarized, with the US as a question mark in terms of how exactly is the country going to get involved. Will we see a repeat of July 2025 when we saw tariffs and pressure on the Lula administration? That's, of course, something to be monitored very, very closely. We remain constructive on Brazil. We think Brazilian equities are cheap, and global investors should be taking a look. Mexico, I think it's mostly going to be about USMCA renegotiation. We think after discussions, some tensions, some headlines, USMCA will survive. We think that the US cannot, at the same time, decouple from China and decouple from Mexico. The US is choosing to decouple from China. They need to keep Mexico close by. In terms of helping inflationary dynamics in the US, in terms of maintaining those incredibly deep economic integration dynamics that the US and Mexico have built over the 30+ years of life of NAFTA and USMCA. The other question mark for Mexico in 2026 are reforms, domestic reforms. Many of these are not positive. The electoral reform is the next signpost. Let's see how the Sheinbaum administration tackles some of these dynamics. Argentina. I think you should remind yourself everything you think about Argentina of the following statement. Argentina has a fiscal surplus. This seemed like an oxymoron not too long ago. The country is spending less than comes in. Absolutely wild, sustainable, particularly if you pair that with the fact that Argentina is arguably today the most pro-market reforming country in the world. I cannot come up with another country that is implementing pro-market reforms at the speed that Argentina is. These are strong statements, but I think are backed by facts. Because of this, I believe that Argentina country risk has further room to compress. As we speak, we're at 500 basis points or 5% over US Treasuries. This can come down to a level of 350 basis points in 12 months' time. Chile, what a 180-degree change in approach from a political perspective. Cast won with a very decisive difference, and the country, 6 years into the estallido social del 2019, is regaining some stability, is refocusing on, the economy, and we see this positively. Colombia, it is really all about the elections, headlines that are reshaping the race in the last 24 hours, involving candidate Cepeda. The momentum is in favor of the right, but as the chart on the left suggests, the atomization of the right is hurting its prospects. Let's see how this pans out. This is going to be essential. I think the regional dynamics also support a shift to the right in Colombia. Ultimately, whoever wins will need to have a fiscal plan. Fiscal dynamics in Colombia leave a lot to be desired. They're very concerning. It takes a lot of work to straighten them out. Priority and focus is of the essence. Peru will have an election this year. Luckily, it is a more quote-unquote Teflon country where politics matter less for the economy. Growth is being supported by improving terms of trade. Growth has been supported by some mega projects having come in line, like Chancay, and regional dynamics from a political perspective may also support an improved political cycle in Peru, adding to that prior political reforms should lead to more stability in Congress. All right, I think with that we covered so much ground. We have coverage of Panama, we have coverage of the Dominican Republic. We can, of course, talk about Venezuela. I'll leave it to the audience to see where we put our focus. Tatiana, let's open it up. I want to share a couple QR codes so that we remain in touch and maintain the conversation. The first QR code is for our podcast. It is available on any platform: Apple, Google, Spotify. We have a Spanish version. We have a Portuguese version. I hope you like the way we cover global and Latin American topics in this initiative. And we have my LinkedIn newsletter that I love for participants to connect and engage. I published a piece on Monday, for instance, arguing that emerging markets are the fiscal adults in the room. Tatiana.
Great. Thank you so much, Alejo. It is always a highlight to listen to you. And let's see, we have the first question here from Shmuel Yerushalmi. How, according to your opinion, industrial and developed countries can support resolution problems of poverty and improvement social and economic well-being in poor and developing countries of Africa, Asia, and Latin America?
Such a profound question, Tatiana. I would say the environment globally is becoming tougher, not easier, for this in this realm, right? I think multilateralism is suffering a set of very strong blows. The relevance and the funding of institutions such as the UN is under quite a bit of stress. And so I think the world is seeing an erosion in the role of those forums that historically at least helped industrial and developed countries sit down with developing countries to develop a joint agenda. At the same time, I think there's an more acute focus in more bilateral moves. And I think you'll see countries like the US acting more forcefully in Latin America. with a multiplicity of goals, but among them, trying to mitigate migration flows into the US, which requires economic development in Latin America. So maybe there's an area where you could see win-win situations. And then you've got China that is seeing the void that the US is creating in some respects and trying to step in Africa and in Asia, right? So in short, I think by and large, the world is tougher for this type of cooperation and impact. But, not all hope is lost, considering I think bilateral engagement is on the rise.
Thank you, Alejo. I don't know if you want to stop the screen sharing, then
Yes, absolutely.
see you better. I have another question here from Henry Raymond. When could UBS open a branch in Peru, taking in consideration there are several prospective projects in mining and communication techs in short run?
I will give Luis the opportunity to reconnect, but in the meantime, I'll say we're in Peru all the time. I'm in Peru several times a year. I love visiting the country for business and for pleasure. We actively cover macro politics in the country. We actively visit our clients in the country. So irrespective of whether there is a physical UBS office, I mean, we continue to do deep work involving Peru. But Luis, I think we can hear you.
You're mute, Luis, I think.
Absolutely, Alejo. Great answer, and I think it is the right answer. Peru is extremely important country for us, a country that we also very constructive in terms of development, mining, but there's also other sectors where we are involved, and it's either from our colleagues in the US, from the Switzerland, and the question of an advisory office or question of an office in a country involves regulatory, tax, and legal questions. So it's always a broad discussion and a balanced discussion. Having said this, actually, our license in the Chilean office allows us to serve also clients in Peru from the Chilean office. So I guess the answer is extremely important, and we continuously review our footprint.
Thank you, Luis. I have another question from Philippe Nel, our honorary ambassador here in LATCAM. How do you see the Donroe Doctrine? How can Latin American countries benefit therefrom and engage in more reforms whilst US appears to pursue very specific interests linked to natural resources and drugs?
Fascinating question, developing story. I am not the holder of the truth here, but I can base my answer on certain facts, right? So I think you have actions by the US administration over the last 13 months that speak for themselves, right? First, adopting a foreign minister of Latin descent for the first time ever. The first international trip that Marco Rubio engaged in was to Latin America. That is not something that you would have expected from the prior administration or the administration prior to that, or for that matter, the prior 25 years. And the administration came out guns blazing, Panama, right? Brazil, Colombia, to a certain extent, El Salvador, Ecuador, and of course, Argentina. The national security document published late 2025 puts it in writing, in a way, just reigniting this America's hegemonic influence. I think U.S. objectives towards the region, yes, have to do with migration and drugs, but are broader than that. And the case of Argentina is, again, I hate, as an Argentine, you buy an Argentine for what he's worth and you sell him for what he thinks he's worth, and you make the most money in your life. So I'm going to go back to that example, but it's illustrative. There's no drugs or migration related to Argentina. They did it for other goals, right? And that, I think you could speculate, might have to do with ideology, might have to do with supporting a shift from the left to the right more broadly in the region. You could argue so many other things, right? So, look, I think we're learning by doing. I would rather see a region that is paid attention to, that is sent resources to, than otherwise from the US. It's at the same time not an easy environment to navigate for many countries, because after 20 years of very, very deep Chinese involvement in the region, it's going to be a tightrope to traverse for places such as Brazil, such as Peru, such as Chile, and Argentina, Ecuador, among others, right? But look, I think it's just another manifestation of the fact that the world needs us more than they used to. And the world is looking at us with more sharper eyes than they used to. And I think that's a good thing.
Absolutely. Thank you for that. Next question, Joanny Hernandez. In your view, how sustainable are the positive effects of higher prices for Peru's main mining exports on economic growth and fiscal performance?
We think they're very sustainable. Peru's main exports are copper, gold, and other commodity-linked products. And when it comes to the overall commodity complex, but specifically precious and industrial metals, at the CIO of UBS, we maintain a positive view. And we think, severe underinvestment in exploration and production over the last 10 years is finally, being reflected in price dynamics. Let me be more concrete. There's been almost no new copper mines being opened worldwide for a couple of years already, right? I mean, now people are looking for critical minerals everywhere, but nobody has been focusing on taking it off the ground for some time. And so the countries that have been consistent at it, like Peru, today experience an edge. So I think this should be positive for some time. It's not 1 month, it's not 3 months. I think you're talking about quarters or years for Peru growth and Peru fiscal dynamics.
Thank you for that. Last question for the moment. Thank you for your presentation. What would be an ideal percentage of AI equity investment of total portfolio? Diversify IA into emerging markets?
Yeah, excellent question. I think it's impossible to provide a one-size-fits-all answer, because the starting point of any investor matters so much. right? And I'll give you just very extreme example. If you are an employee of NVIDIA and you're sitting on NVIDIA stock, what's the optimal AI allocation of your portfolio? That's going to be very, very different from somebody who, is working out of Colombia in the pharmaceutical sector. So it matters greatly what your overall wealth profile looks like, your geographic biases. Therefore, it's impossible to tell you everybody is a size 42 shoe, right? That said, we have some models. What I can tell you first is, and it's correlated with the question, many investors are sitting on 80, 90% allocation to US assets, heavily tilted towards technology and artificial intelligence in their equity portfolios. We think that's too much. We think something closer to 60, 65% allocation to US asset, which has a strong tilt towards AI, makes more sense. That you gotta reserve the 35, 40 remaining portion to Europe, to Asia, to Latin America, right? And this will include AI, because I like to remind folks that a company like NVIDIA would collapse overnight without Taiwan, where 90% of its chips are manufactured. A company like NVIDIA would collapse overnight without the Netherlands, where the ultraviolet machines the size of a bus and costing $300 million plus are manufactured. I'd sent to Taiwan to produce the chips. NVIDIA without Germany, where they microscopically polished mirrors that go into the Dutch machines that go into the Taiwanese fabs are produced, would collapse. So my point is, AI is not US. It is, very much a lot of innovation, a lot of ideas, a lot of value creation, but it's supported by a global network that is a necessary condition for this story to succeed. So maybe I'll answer the question with a geographic, guidance. Be mindful of that and just spread your bets geographically, because this matters not only for AI, it also matters for geopolitics.
Thank you very much. That was the last question. No, actually, we have one more question if you have time. Also,
yes.
Nell, how do you assess the fair, reciprocal, and balanced US trade policy toward Latin America, despite the fact that almost all Latin American countries register a trade deficit with the US? That will be the last question.
Yes. What I love about Tatiana is that every year we go down to the last 30 seconds of the call with questions, and it makes me feel like it makes a difference. So appreciate it. It's an excellent observation that dates back to Liberation Day on early April 2025, when you looked at how the numbers in the Trump table that made headlines all over the world were crafted. There was something about trade deficits, but then there was a universal 10% minimum tariff, right? And to the participants' question, most Latin American countries have a trade deficit with the US. That is, the US has a trade surplus with this country. So, why impose tariffs? To be very, very, very frank, it's not clear to me. I think it's just a modern mercantilist approach that the US administration is taking. There is deep appreciation in the US administration for tariffs. And, I would think within this reality, Latin America had it easy, because it ended up with the by far lowest effective tariff rate of any other region in the world. And countries in Latin America have by far the lowest effective tariff rate of any country in the world, Mexico being one of them.
Great. famous last words of today's session, and we have reached the end. I want to express our gratitude to Alejo Czerwonko for providing clarity and perspective, many positive angles, as I told you, and food for thought and action. Thank you also, Luis Cardoso, for addressing our viewers and sharing your perception of what's happening in Latin America and in the markets. It was a privilege to have you both with us today. Dear viewers, thank you all for connecting and sharing your concerns through Q&A. You will receive a Zoom inquiry tomorrow. In case one question comes to mind later, please email it to me and I will share it with our speakers. You will be able to review Alejo's presentation on our website if you click on this event. And if you missed part of today's session, the recording will be uploaded to our YouTube channel, LatCam Switzerland, very shortly. Don't forget to like us and to comment. This will raise our visibility, I'm told. Once more, thank you for your interest. Stay tuned for our upcoming events and webinars, and I hope to see you again on the next occasion. Till then, all the best, be safe, and goodbye.
Thank you.